It probably won't surprise you that BlackRock, the world's largest money manager, has been planning for a U.S. sovereign downgrade for some time. Just imagine if it hadn't. This morning, we welcome the man responsible for much of that planning, Peter Fisher. He oversees $1.1 trillion as BlackRock's head of global fixed income. Peter was formerly Treasury Undersecretary for Domestic Finance, and he also spent 15 years at the Federal Reserve Bank of New York City. Peter, we were led to believe going into the weekend that this wouldn't be much of a game changer because S&P put America on negative watch back in April. The Treasury market was going to move maybe 10 basis points. Futures weren't going to drop that much. Anything but is happening right now. Look, the S&P 500 contract is down 2.5%. Futures are much stronger than, the 10-year Treasury is much stronger than anticipated. Is this a game changer or isn't it a game changer?
Well, all by itself, it's not a game changer. That is, the two other rating agencies still have the U.S. on AAA, but clearly it's a big warning shot. It's a big signal to a lot of investors to wake up. And I hope it's a signal to a lot of politicians to wake up. I think we're seeing the volatility in the market we would have expected. Some investors respond to this by shedding risk. That means they buy treasuries. Some investors respond to this by selling treasuries. They get a little nervous. Maybe some investors over-anticipate the mechanistic reaction, which we don't think is going to happen. Not a lot of investors out here are just selling treasuries mindlessly because S&P downgraded them one notch. So I think it's creating some vol. There's some churning going on in the market. There are a few other things going on, as we've pointed out. The G7's in the mix. The ECB is in the mix. There's a lot going on out here that investors have to absorb. So we're seeing that volatility in the market. But it's frankly a lot less than I think some people might have feared Saturday night or Sunday night.
Really? You think we might have seen, say, futures drop 5% and the 10-year yield go down to 225?
Well, they were down so much last week. That could be part of it.
Yeah, I think markets have sold off a lot in the run-up to this. And also, overnight, the S&P futures have been pretty volatile. They've been down, they've been flat, they've been down again, they've been up. So that volatility is coming through.
Peter, you know who's watching the markets more closely than anybody here right now? My colleague Betty Liu. She's down at the New York Stock Exchange. Betty, jump in.
Thank you, Eric. I want to borrow from Peter's Treasury background and say, what did you make of the statements that have come out from Treasury in reaction to this? Are they actually fueling the fire by going head-to-head with S&P?
Well, obviously, the so-called $2 trillion mathematical mistake was upsetting to the Treasury. I can imagine that if I was still in my old job, that would be pretty disconcerting to me. So I think I probably wouldn't be picking a fight with S&P right now. That's not how I would do it, but I understand how they feel. So I think that they should take a step back, and clearly the Treasury, shine the light on Congress. That's where the next act is going to unfold in Washington. And I think a lot of investors ought to take a break and wait and see what happens to the super committee in the fall. We might get more fiscal discipline than people have anticipated, or we might not. There's another act to play out in this drama.
I know a lot of people, probably your folks, your lawyers, were all gathered over the weekend to try to figure out what the implications of this are. Fed says no implications for open market operations, but a lot of transactions in the markets, repos done in between individual organizations. They all have their own credit ratings of each other. What's your sense of how this plays out in terms of any possible market dislocations?
Well, that's what we really spent several weeks preparing for the risk of this happening. We didn't expect it would happen on Friday night, but we were preparing, making sure that all of our investment guidelines, all of our collateral agreements could anticipate a split rating. As I say, the vast preponderance of the portfolios we manage rely on all three major ratings, and they look at an average of them. A very small number, less than 1% of the portfolios we manage had binding constraints that might come about because of S&P's action. But we've been working on those for the prior weeks so that we could come into this morning and not have to be a forced seller of any assets.
But Peter, what happens if it's no longer a split rating? What happens if and when Moody's decides that the United States does no longer merit a AAA credit rating, or Fitch decides that the AAA is off the table?
Well, that brings more of those guidelines and constraints into play. The U.S. is still, because 2 out of 3 of the agencies rate them AAA, about 60% of the AAA universe that's issued out there in the world. So if you really think about downgrading the U.S. completely out of AAA space, you're completely changing the dynamic of what the quantity of AAA assets there are to invest in. So investment guidelines and the way investors think about that is going to have to shift completely. And there'll be a lot of changes as investment guidelines and how people approach the market, what their asset allocation is, if that comes about.
What risk is there in Treasuries?
Well, I think the ability and willingness of the U.S. to pay its debts is pretty good. I don't think we're going to...
Even after what we saw play out over the past few weeks in D.C.
Even after what we saw play out. We've had a debt ceiling increase. You know, I don't know how many times in my career at the Fed and the Treasury. It's several dozen times.
But is pretty good enough?
No, I just want to be clear. I don't think the U.S. Treasury and the U.S. Congress is going to let us default through a debt ceiling. They're not going to do that. Now, they had a lot of histrionics about it, and I think it went a little too far this time on both sides of the political spectrum. Now, so I think the U.S. economy is still a great economy. We've got some challenges ahead of us. I think it's a great place to do business. So I think that there are revenues that are going to be out there. There's the risk that our political leaders figure that out, how to tax and collect revenues and cut back on spending enough to get our fiscal path in order. Now, I think that's likely to happen here, as in any country in the world. It's not going to be pretty because of the way our political process goes.
You said you have confidence in the U.S. economy, but do the investors you talk to, the companies you talk to, have confidence in the economy? They're not hiring, they're not spending. Is this going to change that?
My confidence is about the 75-year horizon that we're going to pay our bills, right? The economy is weak here, and we're worried about how weak it is. So that cash on corporate balance sheets we just referred to, I think what we all hope happens is that turns into new business fixed investment, that business confidence picks up, and we see that money not just being paid out as dividends, but being invested.
Does this stop that from happening?
Well, that's the concern. I think we've had a pretty big shock to business confidence over the last month. The data revisions, the slow GDP. The question is, will this S&P downgrade, will all the hoopla around this be a further shock to business and household confidence, or will it not? And in that really hangs the path of the economy over the next 4 quarters, I think.
Peter, with all the ugliness and the shock risks out there, does BlackRock advocate buying gold at $1,709 an ounce?
Well, there's certainly some funds we provide that are invested in the commodity market and the gold market. I think that it's a little toppish for my personal taste at these levels, but certainly portfolios can be diversified and have a piece of that market.
Peter, I know Larry Fink has been a big dollar bull, told me so months and months and months here on the Inside Track. How do you feel about it? Because fixed income and currencies are so inextricably tied. They're basically the same thing.
Well, yeah, there's a close correlation there in how these markets trade. I think it's a little too easy to think the dollar trades down because there's bad news in the U.S. I think that's the prior segment we just looked at suggests that if the U.S. is going to start getting its fiscal house in order and the government's going to be constrained on how much borrowing it could do, that's probably going to turn into be a good picture in the long run, even if it has the risk of weakening the economy in the short run. Now, they've been talking a lot about that in Washington, about how the budget deal shouldn't cut too much in the first few years and then cut more in the future. The more we do of that, and we'll see what happens over the next few months in Washington, the better it's going to be for the U.S. outlook, and I think better for the dollar.
Peter, what is it going to take to restore calm in the markets? What's it going to take?
Well, it'll take a lot of things. One of the things it'll take is for us all to adjust, the politicians, the economists, the investors, to the fact that we're on a lower growth path and one that is more volatile. In the 50s, 60s, and 70s, we had recessions every 2 or 3 years, and we thought times were pretty good in the 60s, but we still had a recession every 2 or 3 years, and the growth path was lower than we were used to in the 90s and the last decade. So that's a big part. The politicians don't like that. The economists are struggling with it. We've all got to understand we're on a lower growth path, but it's also more volatile, and then we've just got to learn how to price and adjust to that.
BlackRock and Sara Eisen is here to talk about credit default swaps. Sara, why do we care?
Because it is telling a very different story than the one told by S&P this weekend. We know how S&P feels about the United States creditworthiness. Here is how the credit market feels, totally different. Here's the United States, pricing in a 5.4% probability of default at this point. Here are the other AAA rated nations. U.S. is not AAA rated in the eyes of S&P. Canada is, UK is, France is. And look at that. In France, the credit default swap market pricing in more than double the odds of default than the United States. There's a major disconnect between the market and between S&P.
So it makes you wonder, on the one hand, Peter, if S&P should downgrade France instead, or when investors are going to start treating the U.S. like other countries with unsustainable debt burdens?
Well, I think the first question is the one that's on the market's mind right now. That is, S&P has downgraded the U.S. The other major agencies haven't downgraded the U.S. But what we have is the risk that they're going to downgrade other AAAs.
Peter, so good to have you here.